Path stock rocketing higher. This is for UiPath, up over 25% following their third quarter results. If you look at the stock price over the past year, it's now clearly breaking out from its 200-day moving average. So the question is this part of a new uptrend for Path stock, or are you talking about, tough valuation headwinds? Why is it even, rocketing higher from here following these earnings results? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. So if I want to understand what's going on with UiPath, I go to AI Ticker Chat. First month is free. I click on earnings transcript, latest earnings transcript. I go, why might Path stock be up on these results? And it really nails it. It talks about the 24% growth in annual recurring revenue. This is a key metric that a lot of folks are following. It reflects a reacceleration in the underlying business, looking at non-GAAP operating margin, so underlying profitability, increasing by more than 6% or 600 basis points year over year. So talking about improved efficiency, management highlighted free cash flow of $44 million and client net retention rate of 123%. So saying the customers are very sticky and they're spending more. If I wanted to dive deeper into understanding UiPath's story, I could also look at some of these exclusive transcripts, these non-earnings transcripts, such as their recent investor day and some Wall Street conferences, if I wanted to get a greater perspective on what's going on. So what does UiPath even do? So the way to understand it, I'll do a very brief overview. So they call it robotic process automation. Now it's, leveraging AI. What it really is, it's talking about looking at what's going on your screen or looking at what's going on across multiple screens, discovering, okay, this is sort of a manual process that can be automated. So it's about understanding the processes, mining the different processes, having a bot effectively stare at multiple screens and saying, oh, we can easily do this for you and we can automate it for you. And then ultimately, you don't have to do the jobs that you might find dull or repetitive. Why not have a smart AI do this for you? And so this is really, while it's called robotic, it's really an AI revolution that's coming in here. And there's more to that in just a second. I'll talk about one of their latest products, Clipboard. But as they've rolled out these solutions, one nonprofit healthcare company in the United States has seen over $250 million in savings since rolling out UiPath solutions, where it helps them with supply chain or pharmacy claims administration. Most recently it had to do with home care and infusion services. So it's about looking at, and with healthcare, you're looking at a lot of paperwork, sometimes dealing with very annoying manual tasks like faxing things over. So can you have this automated and easy way, save a lot of time and money? And clearly that's what you're seeing here. And that's also what you're seeing with, the customer retention, that 120%, the same customer spending 20% more. Clipboard AI, this is pretty neat. They're still rolling it out, so it's very early days. I think Time called it one of the top inventions for 2023. Really what you're talking about is leveraging the GPTs, the AI, this revolution that's going on, and saying, hey, you could take a picture, let's say, of your ID, and instead of you having to type in the information, it could just say, oh, well, based on the picture of this, it can now fill out the form. Or maybe you have an invoice and you say, hey, this needs to get paid. It can automatically fill out the respective forms just based on the email that you get of, oh, this is something that needs to get paid. So, creating this sort of approval process using GPT, using the logic of AI, getting married with effectively UiPath, taking their technology. So this Clipboard really is an exciting development. It's not surprising to see, a lot of large corporations saying, hey, this is now becoming a C-suite priority. This is where the top dogs of the corporation are saying, hey, we need to figure out what we're going to do here. And they talk about how effectively customers paying over $1 million in annual recurring revenue, that's up over 30% year over year. So this is what Wall Street really likes to see. But in my opinion, I've called this out before. This is really a reflection that for UiPath, this technology is going to become table stakes. Everyone's going to be using something like this over time. Now, they're not the only player. There's a lot of different players like them. But so far, their execution, least based on their third quarter results and for the last few years, looks favorable with them growing and taking share. Okay, so the question is, where does UiPath go from here? Because, you see it running up today on their third quarter results. So first, in full disclosure, this is not financial advice. Also, quick plug at Unrivaled Investing. My goal is to help everyday investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies that I can partner with and hold for years with the prospects of hundreds of % upside. I share my investment journey in a weekly letter at unrivaledinvesting.com. If you'd like to learn more, I expect to raise the rate for the premium subscription later this year. So now's the time to lock it in. Looking at UiPATH, they have delivered strong annualized recurring revenue, 35% CAGR over the last few years, 24% recently. These are very strong metrics. This reflects, in my opinion, one of the key things that I'm looking for. To assess the health of a company. Are you taking market share? Are you growing with the market? Or are you losing market share? If you're losing market share, it suggests that you do not have a strong or unrivaled value proposition. So it's probably not something that I'm going to want to align with. But if you're growing at the market or growing faster than the market, that means you're probably doing something right. You have something special that customers want. It might mean that you have a right to win going forward. So I look at their growth rate now. I look at their growth rate historically. I think that they're growing at least with the market. So it does suggest that they are winning and it's resonating with customers. This is what I like to see. What I don't like to see, however, is that they still have sizable losses. When you look at Microsoft, when it went public decades ago, when they were at this size, they were generating real profitability. So I don't like to see, a company that's still generating sizable losses. Now you might say, well, wait a second, Daniel, that's just a new era. I personally think, well, wait a second. Interest rates are now, you can now get 4 or 5% on your cash. See the link below. I keep my cash at Interactive Brokers. So having a company that's at a loss, I want to see profitability. That's really what it comes down to. And it might suggest when you see a company at a loss versus a company, once again, going back to the Microsoft example, when it was its size decades ago, it was very profitable. It might suggest a more competitive environment. And so that is an important, element to consider when you're thinking about this. Now, some people might say, Daniel, you're missing the bigger picture. The bigger picture is that their free cash flow is significant. They're generating over 150 million in free cash flow. The problem is that all of it is being generated from stock-based compensation. So this is really more of and this is why I talk about with Unrivaled Investing, I want companies where they're aligned, management is aligned with shareholders. If you think and you do these adjusted figures like they do here, where they say, oh, we're actually really profitable, but we're spending hundreds of millions of dollars on stock-based compensation, we're not aligned. Because what you're really saying is we're diluting the pie each year, and share count year to date is up another 3%. So whatever growth rate you're looking at, it's actually not as good because you have to factor in, the share count is also higher by 3%. So what you're really talking about is, growth closer to 20% per share because that share count growth with hundreds of millions of dollars being spent on compensation. So this is the part where there's misalignment. When I want to think about where does it go in the years ahead, I go to AI Ticker Chat once again, check out their AI Predict feature. Now, this doesn't yet bake in the third quarter growth figures, but it is, giving a 5-year projection that I think is well within a reasonable range, saying around 20 to 27% growth rate, 15 to 25% profit margins. They have historically been nowhere near that. They're still at a loss. So this is giving them a lot of credit, saying, hey, maybe it trades around 30 times multiple, in 2028. And you're not talking about over 100% upside. You're talking about some downside in the downside scenario. So I look at this and say, yeah, this isn't that compelling. I'm going to run my own figures, tweak it a little bit, but broadly, this isn't that great. I might want to see, what is, the sell side thing. So I can click on that little bar chart that shows the revenue. And, I could see Wall Street analysts are actually lower than what AI Ticker Chat is forecasting. So this might be part of the reason why, the stock is up, because investors are going, oh man, maybe it is more aligned with what AI Ticker Chat's predicting here. Maybe that growth rate's better. But I look at this, it's important to have this range of figures to think about it. I plug it into my own framework, thinking about it on an ARR basis versus revenue. And, looking at it, I assume 13 to 19% growth in the years ahead. That's on a per diluted share basis. Assume, a little bit more conservative earnings multiple. This is just because I want to be conservative with how I, consider my investments. And it's just really not compelling over the next 5 years. So even though, the stock has done, has ripped higher today following this third quarter results, it does make me wonder if folks are getting ahead of themselves. Because, you are, it's exciting to say, hey, AI revolution, a company that's going to be, participating. And keep in mind, that's a hypothetical framework. Stock prices go way higher, way lower. But you always need to justify and ground your figures, in sort of some fundamentals. And so are you really going to be growing at 19% or greater over the next 5 years, have a 25 times multiple, and have, earnings margins, keep in mind they're negative now, of closer to 30% 5 years from now? And in that scenario, you only have 50% upside. So I just, I personally think that this is fully valued. It's exciting to think that they're going to participate in the AI revolution. Maybe they do even better than that upside scenario I'm calling out. But I also am very mindful that with this AI revolution, there are going to be players like Microsoft that have made it very clear that they are backing OpenAI, and OpenAI is going to directly integrate their tools with Microsoft, Office Suite, which will be directly competitive with UiPath over time. Maybe it's not there yet, but over time, that will be a greater competitive threat. I also think, just thinking about the valuation, this week's letter, each week I do a weekly letter for my subscribers at Unrivaled Investing. This week's letter, I'm calling out, a top holding that's growing faster than UiPath and trades at less than half the valuation. So I just think, this is an example where people get excited about the sizzle. And with the sizzle, they're willing to pay up. But I'm a steak guy. I want the steak and the sizzle. And I don't want to pay just for sizzle. And so I'm looking at UiPath and I'm like, it's an attractive story. They're heading in the right direction. There's a lot of cool products that they're going to be rolling out. But I want to see more discipline around, their expenses, their stock-based compensation, the share issuance. I want to see real profitability, real free cash flow that's not entirely from stock-based compensation. So I'd like to see more alignment with shareholders. That said, it's an interesting story. I just think it's too fully valued. But, look, maybe it does well from here. Maybe it just keeps going and maybe they exceed my expectations. And I hope it does for the shareholders that are involved. So if you have a different opinion, please let me know. I do not have, a stake in UiPath. So I'd love to hear your thoughts. Thanks so much for tuning into Unrivaled Investing.